Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I am Arjun Patsarthi. And in this fortnight's podcast, I'm going to talk to you about why are yields still high in short maturity bonds, despite the fact that the Reserve Bank of India has uh, kept a pause on rate hikes, and also the fact that the money in the system has increased substantially over the last few months. All this put together should have actually brought down short-term rates, but it the yields are still very high, and this offers an opportunity for investors. Also, it makes one think about where are the long-term rates headed. Now, let's take a look at the why short-term rates are still high in bonds. But before that, if you're a financial advisor, the best place for you is INR Bonds Partner Portal for you to take the best investment decisions in fixed income for your clients. Just log into Partner Portal, check all the bonds on offer, the most information, transparency in prices, and the easiest of execution process for your clients. Log into INR Bonds Partner Portal and sign up as partners and see your fixed income assets under advice grow. Uh, the the short-term rates are still high in bonds, largely because of the fact that there is still a lot of the rates in the benchmarks are still high. Now, if you take say even FDs offered by PSU banks, the rates are still closer to 7%, around 7.2%, 7 to 7.2% for most of the good banks. And even the government bond deals, if you take the short-term rates from treasury bills to 5-year yields, they are still in a range of around 680 to 7%. And the RBI has maintained the repo rate at 6.5%. Liquidity is much better in the system. It had touched almost 2 trillion rupees a couple of years back before coming down to below rupees 500 billion on the base of on largely due to advanced tax outflows. Now, what does this effectively mean is that borrowing costs for corporates are still high at the short end. So you have NBFCs, including uh, the best ones like Bajaj Finance, still borrowing 1 to 2 year rates at closer to 7.5 to 8% levels. So are the 3 and 5 year yields at still around those levels for the top rated bonds. The slightly below that, the Chola rates of Cholamandalam, who's done excellently well in terms of results and everything else, the 3 year bonds are trading at closer to 8.3 to 8.4% levels. And so if you look at the top notch credits, 3 year bonds in the range of 8%, going down slightly, Chola around 8.3 to 8.4%, 3 year bonds. And you have the other credits, including Shriram Finance and others at 8.5 to 9%. And then you have the lower rated bonds, which are maturing in, say, 1 to 1.5 years or even 2 years, like AA to A plus kind of rated bonds in a range of 9 to 10%. So these clearly the short-term yields are still high in the system. But having said that, if you look at the fourth quarter results of all the lenders, they have shown excellent results. And as we await the first quarter results, there could be very reasonable results given the guidance. But having said that, because of the high short-term rates, there could be some slight pullback in terms of the growth in lending as well as in the economic growth. So all this put together, you do see some kind of anomaly in the system, where on one hand, inflation is down, rates are paused, liquidity is good, but rates are still high, largely because of the fact that um, there is good demand for credit. And because there's good demand for credit, there is growth in the economy. But with rates still high, can this continue? So all this presents a problem to investors, also an opportunity to investors. So the best way to play this whole scenario is to take advantage of the high rates offered by in the system, and look for companies that are fundamentally doing well managed. And if you get anything in a range of say 8% to 9.5, 10%, where you're comfortable with the risk, then it does make you can look at those kinds of bonds closely. If you will go down, you do have lower rated bonds, A minus kinds, in a range of 11% and all that. Those obviously are much higher risk investments, and investors should have the capability of taking on such risks. Yeah, again, giving out the risk factors in bonds. The bonds, corporate all bonds carry interest rate risk. And that means if interest rates go up or down, the prices also go up or down, and there is risk of capital loss. Bonds also carry credit risk. That means if corporate fundamentals are turning weak, then there could be risk of even default on the principal. And the liquidity risk is when uh, the bonds are not saleable in the secondary market. So investors have to be aware of these risks before they take investment decisions. Best first places to go is your financial advisor, who will tell you which are the correct bonds or the portfolio of bonds to invest in. Put together, I think investors should look at the opportunities available at the short end. And short end always gives you much better visibility. And if investors the way we look at the macro environment at this point of time, I think rates are going to be held at higher levels, but liquidity is getting more comfortable. That provides a um, good amount of uh, strength to the investors in terms of visibility of where the rates are going to go. So short-term rates are going to be largely stable, may not come down very soon. So investors should not expect to make capital gains out of buying into short, longer term bonds and trying to sell it down, because long-term bond yields are still down. So better to take advantage of the higher yields offered at the short end. Thank you very much for listening in, and do follow us on all podcast channels.